Warren Buffett just shifted hundreds of millions into oil. Ray Dalio bought 214,000 ExxonMobil shares in a single quarter. And while the public is being told that oil is obsolete, the sharpest capital on the planet is acquiring energy assets at scale. What they understand could determine whether your wealth survives the next monetary breakdown or disappears with it. Because we are already in stage 3 of a 4-stage cycle. Stage 4 is where the wealth transfer takes place, and it has begun. This isn't speculation. Berkshire Hathaway holds enormous positions in Chevron. Ray Dalio, who oversees $120 billion and built his worldview on studying debt cycles, added another 214,000 ExxonMobil shares in a single quarter. These investors aren't speculating. They're responding to mathematical patterns that have repeated across history. The same pattern that crushed Germany in 1923, the same one that ended the gold standard in 1971. And it's unfolding again right now. Here are the numbers that matter. Global debt sits at $318 trillion. Your retirement account is denominated in dollars. Your pension is losing purchasing power month after month, and you likely haven't noticed. U.S. interest payments have tripled in 5 years. They're on track to reach $1.8 trillion by 2035. This isn't policy drift, this is mathematical endgame. When systems reach numerical exhaustion, they don't adjust slowly. They fail into the next phase of a pattern that is never missed. Understanding this pattern is the difference between surviving what comes next and losing everything. The pattern has 4 stages, all observable, all historically confirmed. Stage 1. A currency backed by something real, gold, silver, productive output. This builds confidence, and confidence creates stability. Trade expands. Prosperity can last decades, even centuries. Stage 2. Expansion through debasement. A shock hits. War, recession, political strain. Authorities begin issuing currency beyond what real assets justify. At first, it feels like prosperity, but the foundation fractures. Stage 3. Crisis of confidence. Savings erode. The middle class watches its wealth vanish. Pension funds implode. Yet the government can't stop printing. Debt service consumes revenue. Today, 3.4 billion people live in nations where debt payments exceed spending on health or education. A death spiral forms. Debt crowds out growth, growth slows, revenue falls, borrowing rises, debt compounds. The math is unavoidable. Stage 4. The reset. The currency collapses or is abandoned. Wealth moves from paper holders to those with tangible assets. And the most essential tangible asset, the one every society requires to function, the one that cannot be created by decree, is energy. Oil. This isn't theory. Watch what happens next. Germany, November 1923. You order a coffee, 5,000 marks. In 18 months, the mark disintegrates from 320 per dollar to 4 trillion per dollar. Before World War I, Germany's gold-backed currency was trusted worldwide. Stage 1. Then war financing began. They printed, assuming victory would pay the bill. Germany lost. The Treaty of Versailles demanded 132 billion gold marks, over $500 billion in today's terms. Stage 2. By 1920, 4 marks per dollar became 69. In 1922, brief stabilization was proposed at international conferences, but nothing was implemented. By December, the mark hit 7,400 per dollar. The cost of living index jumped from 41 to 685 in 6 months, a 17-fold surge. Stage 3 slammed into the system. In January 1923, France occupied the Ruhr Valley. Germany ordered passive resistance and printed money to support workers who stopped producing. Hyperinflation detonated. By November, $1 equaled 4 trillion marks. Stage 4 arrived with the Rentenmark, backed by mortgaged land. Stability returned overnight, but the destruction was irreversible. The middle class erased, pensions gone, savings worthless. Those who held land, industry, or commodities survived. Those who held paper lost everything. The 4-stage pattern held exactly. Asset-backed currency, expansion, crisis, reset. Now watch it unfold in the United States. July 1944, Bretton Woods. The U.S. holds the largest gold reserves in history and dominates global industry. International trade surges. But Stage 2 begins in the 1960s. Vietnam. Great Society programs. Massive fiscal expansion. Dollars printed far beyond gold reserves. By 1966, foreign banks hold $14 billion. U.S. gold reserves $13.2 billion. The ratio flips. France sees the danger first. In February 1965, Charles de Gaulle announces he will redeem dollars for gold, calling it America's exorbitant privilege. In August 1966, France sends a battleship to New York to collect its gold. Other nations follow. U.S. gold reserves collapse from 20,000 metric tons to under 10,000 by August 1971. Stage 3 peaks on August 15, 1971. Nixon meets secretly at Camp David with top monetary officials. That evening, he announces the closure of the gold window. The dollar is now backed by nothing but confidence. But here's the pivot that changes the next half-century. The dollar doesn't fall. Treasury Secretary William Simon flies to Saudi Arabia and brokers a deal. Military and political support in exchange for pricing oil in dollars and recycling petrodollar revenue into U.S. treasuries. The petrodollar is born. The dollar is no longer tied to gold, it's tied to oil. As long as oil trades in dollars, global demand for dollars is locked in. This allows the U.S. to run deficits, print currency, and export inflation. The cycle reinforces itself, but gold's discipline is gone. The restraints vanish. Fast forward to the 2008 financial crisis. Trillions are injected. Rates fall to zero and below. Government debt explodes. U.S. debt jumps from $10 trillion to $20 trillion by 2016, passes $30 trillion in 2022, now sits near $38 trillion. Debt to GDP, 65% in 2007, 135% by 2020. Then 2020 arrives. COVID hits. Expansion accelerates at a pace with no historical parallel. Global debt grows by $54 trillion between 2020 and 2024. In 2024 alone, another $7 trillion is added. Total, $318 trillion. After a decade of near-zero rates, the Fed pivots in 2022. Inflation breaks above 7%. Rates surge from near zero to over 5%. This is stage 3, the crisis of confidence. Net interest payments have reached $892 billion. In fiscal 2024, they're projected to hit $1.8 trillion by 2035. 61 countries now spend more than 10% of government revenue just servicing debt. The math is becoming impossible to sustain. So where are we in the cycle? Stage 1 was Bretton Woods, done. Stage 2 was the creation of the petrodollar, done. Stage 3 is unfolding right now, and this is where oil becomes central. The petrodollar framework that upheld dollar dominance since 1974 is under the heaviest strain in its history. Saudi Arabia is negotiating oil sales in other currencies. China is advancing the yuan, building bilateral oil arrangements. Russia is accelerating de-dollarization. BRICS nations, 40% of the world's population and 32% of global GDP, are developing payment networks that bypass the dollar entirely. The structural dependence that rescued the dollar in 1971 is weakening. Meanwhile, U.S. oil output hits all-time highs, 13.49 million barrels per day. Yet prices are falling and economic uncertainty is rising. And still, billionaires are buying oil assets faster than ever. Why? Because they know what stage 4 brings. When a currency system resets, when debt becomes unpayable, when confidence in paper evaporates, capital runs to tangible value. Energy is the most essential tangible asset in civilization. You cannot move goods without it. You cannot power factories without it. You cannot operate agriculture, maintain infrastructure, or project military strength without it. Societies can limp along without financial instruments. They cannot function without energy. ConocoPhillips' $22.5 billion acquisition boosted dividends by 34%, with $20.3 billion in operating cash flow. ExxonMobil posted $34 billion in earnings and $55 billion in cash flow, with 42 straight years of dividend growth and $20 billion in buybacks planned through 2026. Occidental Petroleum generated $4.9 billion in free cash flow and raised its dividend 9.1%. These companies aren't speculating on next quarter's oil price. They're positioning for a structural transition in the global monetary system, securing physical production while prices remain suppressed, building dividend streams grounded in real output rather than financial engineering. And the billionaires who understand the pattern are acting the same way. Warren Buffett keeps roughly 80% of his portfolio in dividend-producing equities, not chasing growth, but locking in income tied to actual economic activity. Ray Dalio, whose entire philosophy is built on studying historical debt cycles, recognizes we are deep into the late stage of a long-term cycle that began in the 1980s. These investors studied the Weimar collapse. They studied Bretton Woods' disintegration. They understand that when stage 4 arrives, the wealth transfer will be severe and absolute. Look at the macro landscape right now. Global debt, $318 trillion. U.S. debt, $38 trillion and rising. Interest costs consuming budgets. Inflation swinging between too high and too low. Central banks trapped, unable to raise rates without triggering a debt crisis, unable to cut them without reigniting inflation. De-dollarization accelerating. Alternative systems forming. Oil prices soft despite supply discipline. Growth weakening. Tensions rising. We are in stage 3, advancing toward stage 4. The details of stage 4 can't be predicted. It could be a coordinated global currency reset. It could be regional fragmentation into competing blocks. A rapid shift toward commodity-backed money. Persistent inflation eroding debt, even outright default. History shows the transition is never smooth and never fair. Holders of paper assets tied to a collapsing currency are wiped out. Those who hold tangible, productive assets survive and often emerge stronger. This is why billionaires are buying oil quietly. They're not betting on next month's price or guessing supply shocks. They understand that in the next monetary phase, energy production capacity becomes one of the most valuable assets on Earth. Companies with reserves, refineries, and distribution networks retain utility under any currency system. Exxon will still produce energy. Chevron will still transport it. ConocoPhillips will still refine it. The numbers printed on banknotes may change. The medium of exchange may change. But the need for energy does not. The current world order, built on dollar dominance, unchecked deficit spending, and perpetual growth funded by perpetual debt, is mathematically unsustainable. Debt service drains productive capacity. Monetary expansion no longer stimulates output. It inflates bubbles. Confidence isn't upheld by fundamentals, it's upheld by lack of alternatives. And that absence is fading. You'll hear that this time is different. That American exceptionalism guarantees dollar supremacy. The Spanish insisted the same before their silver system collapsed in the 16th century. The French said it during the Mississippi Bubble. The British said it as sterling lost reserve status. The Germans said it in 1922, just before hyperinflation destroyed the mark. This time is not different. The pattern doesn't shift because technology improves or institutions mature. The pattern changes only when the mathematics change. And the mathematics are simple. You cannot borrow more than you produce indefinitely. You cannot expand currency faster than output forever. You cannot maintain confidence when the issuer prioritizes short-term politics over long-term stability. And you cannot avoid the consequences simply because your currency is the reserve currency. Reserve status is a privilege granted by other nations. And once it's lost, it's rarely reclaimed. The billionaires buying oil aren't making a forecast. They're following a pattern. Positioning for a transition that isn't if, but when. Converting financial claims that can be printed into physical assets that cannot. They're ensuring that when the reset hits, their wealth is tied to something that endures, quietly, methodically, at scale, using the same strategy that has preserved capital through every currency collapse in recorded history. Meanwhile, the public is distracted by stories of tech revolutions and green transitions that won't shield anyone from a monetary system failure. There's always a prediction that this time it won't happen. But before we go further, answer this. Why is global debt $318 trillion? Why have billionaires poured hundreds of millions into energy during weak pricing? Why are oil producers prioritizing dividends over expansion? Why is de-dollarization accelerating despite U.S. dominance? Why are central banks trapped in a cycle where every decision carries catastrophic downside? These are not rhetorical. They're the data points confirming we are in stage 3 of the pattern. And if you understand the pattern, you understand that stage 4 isn't a probability, it's a schedule. The Weimar middle class was diversified: bonds, savings, pensions, land, commodities, industry, energy. The machine didn't malfunction, it performed exactly as designed. Every system has a load-bearing limit. When that limit is breached, the machine doesn't glide into a soft landing, it snaps. And when monetary machines snap, the damage isn't measured in portfolio drawdowns. It's measured in collapsing living standards, erased purchasing power, and a transfer of wealth from those who didn't understand the pattern to those who did. The billionaires buying oil understand the pattern. The question is, do you? The next video will reveal the full history of American monetary architecture, from Alexander Hamilton to the Federal Reserve, from Bretton Woods to the petrodollar. You'll see how the same financial dynasties, the same political incentives, the same mechanisms have shaped every monetary shift. You'll see why this transition isn't an outlier. It's the logical outcome of a system engineered to concentrate wealth through monetary manipulation. Subscribe now. Hit the bell. Because once stage 4 begins, the window to position closes fast. This isn't about getting wealthy, it's about avoiding destruction. Most people won't grasp that until the moment it's too late. They'll watch gold climb and dismiss it as a bubble. They'll see central banks pulling their reserves home and chalk it up to nationalism. They'll feel rising prices and blame corporations. And when the reset arrives, they'll be stunned, disoriented, and unprepared. Don't be most people. The mechanism is already running. Central banks are repositioning. The debt trajectory is untenable. The currency is being diluted. The pattern is nearing completion. The only real question is whether you recognize it. A $10,000 gold repricing isn't fantasy. It's the mathematical consequence of a system that has already crossed the point of no return. This isn't the first reset, and it won't be the last. But it will be the most consequential in modern history, because when the reserve currency resets, the entire global order resets with it. Those who understand the pattern will be the ones who endure. If you want to understand how this architecture was built, how central banks amassed their power, how a system emerged where money is created from nothing and supported by debt, keep watching. If you want the steps to protect yourself, the assets to hold, the pitfalls to avoid, the timeline we're tracking, subscribe now. This channel exists to decode the pattern, to expose what sits in plain sight, to prepare you for what's coming. The reset isn't decades away. It isn't years away. It's unfolding now, quietly, beneath the surface. And once it erupts into view, preparation time is over. Don't wait for permission. Don't wait for confirmation. Central banks have already revealed their judgment. They're buying gold. They're moving gold. They're preparing for a reset. The question is, are you?